You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everyone. Welcome back, Brandon. How's things going?
Hey, going well. I watched The Wolf of Wall Street last night. What a movie.
Oh, did you?
What a movie.
That is a great movie.
Yeah.
It's probably one of my favorites, actually, related to, I guess, just the world of finance.
Yeah.
The Big Short's probably up there as one of my top favorites. But
yeah. I think that if I really want to watch a movie about, stock market investing, that kind of stuff, then it's The Big Short. But if I kind of just want to switch off and just want to watch a funny kind of entertaining movie, then Wolf of Wall Street, man, I just love it. I mean, Leonardo plus Martin Scorsese. Yeah, it's a good movie. So good.
It's one of those long, because it's about 3 hours, I think.
It's 3 hours.
It's one of those really long movies that doesn't feel that long. I feel like some movies feel really long when they're 2.5 hours or they're pushing 3 hours, but it's jam-packed full of entertainment, that one.
It's time flies when you're watching it. Hey, check
definitely
out this news story I just got up. Get a load of this. As the coronavirus continues, Australians have been buying even more alcohol than normal. I don't know if this is a good or a bad thing here. They did some study. What is it? A national YouGov Galaxy poll. It's asked for responses from over 1,000 people. 20% of those people were purchasing more alcohol than usual. 70% of them were drinking more than normal, and a third of them are now drinking daily. Jeez, I don't know if that's a good thing.
I don't know if it's a good thing or a bad thing, but it's certainly not surprising to me. I mean, if more people are not working and there's people on paid leave in particular where there's maybe a little bit not so much worry about their job security, then I don't know.
Yeah, maybe they're just sending it.
Yeah, I don't know.
But it's just like you're sending it by yourself. It's not like you've got 10 of your mates around.
All right, let's do a quick 2-person survey. Has your alcohol consumption gone up since the coronavirus?
Oh, that's targeted. That's targeted. I'll say maybe. What about you?
Maybe. Yeah, I'll say maybe too.
Maybe. Okay.
Actually, I'm not sure.
Results
honestly,
of the study inconclusive. My answer would be no if we took last night out of the equation where I watched Wolf of Wall Street.
Yeah. Honestly, for me, not too much has changed because it wasn't as if my business has not really sort of changed dramatically over this period.
Yeah.
So
we're pretty much running the same as usual. Hey.
Yeah. The only real difference is that I'm not going out with a group of friends as often as I used to. Yeah. So, or at all at the moment. Yeah. So, in that way, it might have even gone down a little bit, but, that was a quick 2-person survey for our audience before we get into
results inconclusive.
Yeah.
Oh dear. Anyway.
Oh dear. Let's get into today's sponsor. So today's episode is sponsored by ShareSite. So ShareSite is an application that I've personally been using for the past few years. And basically it's a piece of software that you can use in order to track the performance of your stock portfolio. And basically, it allows you to keep track of all of the different types of gains or losses that you would benefit from or lose from when you're investing. So that includes not only capital gains, you can enter in all of your trades from some people have trades on different platforms and it's hard to get a gauge of what your overall return is. So you can enter in all of your capital gains. It calculates all of your dividends. If you have dividend reinvestment plans, it will do all of those calculations for you, which is a real lifesaver in terms of figuring out what return you're getting on those shares that are being sort of reinvested. It'll work out your currency gains if you're buying shares internationally, which is a particularly important one if, especially I've noticed this as an Australian buying US shares, there's been quite a substantial fluctuation between the US dollar and the Australian dollar, especially over the past few months. So not being able to know what your currency gains or losses are will impact your overall return. So it'll track your currency gains. And then really the main reason why I use it is because when it comes to tax time. So ShareSite will generate up to 10 different reports, unrealized gains, realized gains, dividend income, capital gains taxes. So there's 10 different reports that can be used at tax time to easily work out your capital gains tax, your dividend income, and more. And you can try ShareSite for free by heading over to sharesite.com/young investors. And that is site spelled SIGHT. So sharesite.com/young investors. And if you use that link, you can get 2 months free when you sign up to a yearly subscription.
Yeah. Wow. Take a breath. What an effort. It passes out. It does it all in one breath. Yeah. Hey, let's move on to this news story. Virgin Australia looks like it's actually in a real spot of bother here.
Ouch.
Yeah. I did do a video pretty recently on the Australian Airlines, but this is looking concerning for Virgin. The article reads here, for the second time this month, Virgin was placed in a trading halt. That was on Tuesday morning this week, so it means that, well, as you've written down here, they haven't traded since the 9th. Thursday. Yeah, because of the long weekend, which is pretty crazy. So they say here that it's asked the ASX to put the pause in place for at least 2 days until it makes an announcement or requests an extension. The company has already seen its credit rating downgraded and is running out of cash as its income has dried up, and it struggles to restructure $5 billion in debt. Pretty crazy. I had a quick look into their numbers for that video that I did recently. And yeah, Virgin Australia, it's not looking good. Like huge capital expenditures, not a great deal of operating cash flow. They've been running free cash flow negative for a very long time. Taking on debt in the process to continue to try and grow their business. So yeah, it's looking like they're in a bit of strife here.
Yeah, this is an interesting situation because there's really two major Australian airlines, there's Qantas and Virgin, right? And Qantas hasn't asked for a bailout. They only asked for one if Virgin's getting one, right? I think that was kind of the headline.
Yeah.
Which is an interesting situation because you have an industry that would be affected if Virgin went bankrupt, but it's not as if both Australian airlines would go under. It's like, I mean, maybe they would, but it seems at this point at least that Qantas is in a better financial position than Virgin. So, the government doesn't seem to be saying anything too much yet about a bailout. So, it's going to be an interesting story. And I presume if they don't get that bailout, they're in trouble.
I kind of think that maybe they've gone into this trading halt as a kind of a push, like trying to push the government to make a decision.
I saw an article that said that it was headlined "Virgin threatens bankruptcy to government."
Yeah,
it's a funny
it sounds
headline.
Backwards, doesn't it?
We'll go bankrupt.
Yeah,
we'll do it.
Maybe they just want to say, "Oh, we need to restructure this debt now to try and give a nudge to the government that if something's going to happen, they want to see it happen right now."
Yeah,
that could bite them in the butt because if they don't get this $1.4 billion bailout, then they're gonna have to take some drastic measures, I think, just to stay afloat. But some of the comments I got on that video that I did is that we say that Virgin Australia, it's one of the two big Australian airliners, but it's basically completely foreign owned. I think actually I need to check this, but I think like the biggest. The company with the biggest stake in Virgin Australia is like Etihad or something like that. Yeah,
it was just a bunch of different airlines that owned 10% here, 20% here. And there was only a very small amount that was just not owned by other big companies. So, it's an interesting situation. I can't say it's an industry I've looked into deeply myself, but it raises a lot of sort of ethical, I guess, or financial questions about whether these bailouts are appropriate.
Exactly.
I was listening to a Phil Town podcast or a snippet from a Phil Town podcast the other day, and they were basically discussing Warren Buffett's investment in the airlines and what might have changed over the past few weeks if he's selling or if he's, what's causing his reason to sell. And they were also discussing, sort of should we let these airlines just go bankrupt and because really if an airline goes bankrupt, it's not as if the brand Virgin would go away. It's more that the shareholders would change. The people who own it, someone else would come in and buy it up really cheap.
Yeah.
And the owners would change, but the brand would still live on in the same way that an American Airlines has gone bankrupt before. And I believe Delta Airlines has also gone bankrupt before. So it's an interesting situation. I think because we're relatively new to investing as well, we haven't seen a whole lot of these sort of big brand bankruptcies play out and see how they come back. So I'm just curious to see the whole process play out, and we'll see what happens in the next couple of weeks for Virgin. It seems like they're really quite up against the ropes at the moment.
Yeah, we shall see. But and then you get the flip side of the argument as well. Whereas if Virgin goes bust and then the ownership changes or whatever, then if Qantas just has such a dominance in Australian market share, do they start price gouging and then screwing us all over because they can basically do whatever they want in the market and that sort of thing? But who knows?
Yeah.
Who knows? Anyway, let's move on to this next news story. I had to chuck this one in because, this is just how's this for a headline, right? Economists warn that things will never be the same again as coronavirus cripples the United States. How's that for a headline?
Go no further, Brandon. If an economist said it, it must be true.
Yeah. Things are they will never be the same again. This is a big deal. Never, ever. It's basically just a story about how retail sales are going down, which is just like, well, no, duh. Of course retail sales are going down. No one's allowed to be open. Anyway, here's the story, right? Retail sales in the US fell by a record amount last month, and factory production slumped by the most since 1946. Not surprising because everything has been forced to shut down. So it says here sales plunged by 8.7% last month, the biggest decline on record according to the US Commerce Department. They fell by 6.2% over the year to March. The $46.2 billion decrease in sales over just 1 month was almost equal to the $49.1 billion peak to trough decline that unfolded over 16 months during the GFC. So, I don't know, this story just kind of annoyed me in the end because it's just such this outlandish headline. Things will never be the same again, and it's basically just saying, look, if you shut down every business in the United States for a period of time, then retail sales will fall quite a bit. Really?
Yeah, these articles are just stupid because not only do they say things will never be the same again, but they compare it to a situation where it happened in the past and it recovered. So were you writing the same article last time when it fell $49 billion in 2008, 2009? Did you write the same article then and said, 2001, it was the same decline in retail?
That's a very good point.
It's always just, it's amazing watching the news. It's just, it's amazing reading articles at the moment. People. It's just ridiculous.
Yeah, I always think about Warren Buffett saying how the reason that he keeps his business operations over in Omaha for Berkshire Hathaway is just because he doesn't want to be anywhere near he doesn't want to be in New York. He doesn't want to be anywhere near the markets. He wants to be as detached as possible. He doesn't want to I can't even remember what the quote is, but I think he said that, if he was walking around New York and hearing everything every day, there's no way he'd be the investor that he is today, because you just hear imagine just walking around Wall Street and all the like how much just junk, how much garbage you'd hear.
You can put your phone away and not look at the articles, but if your job is going into an office where everyone is talking about everything, every little thing that's happening in the morning, and how all of their decisions that they're making, or I sold all of this, or I bought all of this, that would certainly influence your decision making. I mean, it certainly the environment that you're in, that you put yourself in, would have a huge impact on the decisions that you make.
Letting emotions run wild, essentially. Hard to stay rational when you probably hear 1,000 different stock tips or opinions every single day.
Speaking of Buffett, there is some Buffett news that we've got.
Ooh, okay.
Occidental Petroleum, I believe that's the name of the company.
Yeah, that's right. Yeah.
So to give some context to this, so Buffett a while ago helped with an acquisition or a merger that Occidental did. It's an oil company, and in exchange he bought about $10 billion into the company, and he got an 8% preferred dividend, or he has preferred stock. So that basically means his dividend is it's in contract. It doesn't get changed, and it gets paid out before other dividends for common stock. So if the common stock dividends are cut, his likely won't be cut. And basically it came up for his quarterly dividend of $200 million.
Far out.
Which is it's a nice quarterly dividend.
Quarterly dividend. Oh my golly gee, far out.
Yeah. So so it was up for his $200 million quarterly dividend, and basically Occidental's in quite a bit of trouble at the moment, because
as they would be,
they have huge amounts of debt at the same time as oil has been falling dramatically. So oil fell over the past couple of days. US crude is now down at about $19 a barrel.
Right.
And to give some context to that, it was down from a high of $75 a barrel in 18 months ago.
Yeah.
So dramatic drop in how much an oil company can sell their oil for. And as a result, they're really struggling for cash. So Occidental decided that they're going to be paying Buffett in shares instead. So it's kind of an interesting...
I was going to say that the thing that this whole investment by Buffett in this company just doesn't... To me, it just doesn't make sense. It doesn't sound very Buffett-like, because how commonly does Buffett come out and say he looks for companies with great, intrinsic competitive advantages, something about the business sets it apart from the rest. And then he just invests in this oil company, and oil companies all do the same thing. They sell oil, and the profitability of your business literally just comes down to how much you can sell that oil for, which is dependent on obviously the oil price at the time. So I don't know. I don't really get why. Maybe you know more about this than I do. Why Buffett is so interested in this oil company.
Yeah, I mean, I know nothing about this industry, but I mean, getting an 8% preferred dividend when he's sitting on a lot of cash and there's maybe not many other opportunities
that's
is
a good
pretty
point.
good. And it's an 8% dividend at a $10 billion investment. So it's not as if it's a tiny investment. It's a pretty sizable investment that he's locking in, more or less locking in an 8% dividend, although in this case he's getting shares, so it depends on the performance of the shares. And I mean, that's probably going to be the case for the rest of the year, at least. I would say that he just continues to get more shares. So I mean, it's clearly not the classic Buffett company that he talks about in all of his letters to the shareholders. It has huge amounts of debt. It's highly cyclical with many years of negative cash flow. But I mean, maybe he knows something that the rest of us don't. And I mean, I'm sure he does if he's made the investment. But it's certainly a strange one. The only other thing to sort of mention about this story is that this is kind of good for Buffett if he believes that the company will make it through, which if he has a $10 billion investment in something, I mean, I think that even if they were struggling, he would probably step in and make sure that he doesn't lose everything. So it's probably good for Buffett, but it's certainly bad for the other investors who are just getting diluted in the process.
Yeah, that's a good point, actually. So, yeah, if he's getting 8% and that's getting paid now in shares to him, then that is going to start diluting all the other investors.
Yeah, and shares that are down about 65% from their peak. So
good point.
It's diluting the other shareholders at a substantially lower price. I think Carl Icahn is one of the other shareholders I saw on the headline, and I don't really like him, so I don't mind that. I don't mind hearing that.
I don't really like him.
Yeah, he's a meanie.
He's not very nice. Oh dear. No, that's an interesting story though. Should we move on to the next one?
Yeah, let's do it. What have we got?
What have we got here? I should have read this a little bit more thoroughly. The International Monetary Fund, the IMF, has warned Australia's economy would likely be one of the worst hit economies in the Asian region as the global community struggles to contain the spread of the coronavirus. So the article reads as follows. The IMF's latest forecast contained in its updated World Economic Outlook paint a dire picture for the growth and unemployment in 2020. Its central scenario was that Australia's economy would shrink by 6.7% this year. Wow, that's quite a bit. While unemployment would average 7.6%. The report warned it is very likely that this year the global economy will experience its worst recession since the Great Depression, surpassing that seen during the global financial crisis a decade ago.
Wow.
Jeez. Yeah,
that sounds grim.
It does sound pretty grim, and I just wanted to give some context as well, because leading into this, I kind of half knew about the IMF, but I didn't really know. Like if someone came up and said, so what does the IMF actually do? I wouldn't have been able to answer that confidently. So I did a bit of research. So if you're like me wondering what the IMF actually does, it says here the IMF's primary purpose is to ensure the stability of the international monetary system, the system of exchange rates and international payments that enables countries and their citizens to transact with each other. The fund's mandate was updated in 2012 to include all macroeconomic and financial sector issues that bear on global stability. So that's a bit of a background on the IMF. But yeah, this is a very bleak outlook. Jeez, it's holy smokes.
Yeah, it brings up some interesting sort of scenarios or questions, I guess, because Australia, relative to other countries, seems to be handling the health side of the outbreak fairly well, at least. I think we've probably been one of the earlier countries to get somewhat of a flattening on the curve in terms of coronavirus. But because Australia is so reliant, and this is the case for many countries, is so reliant on other countries for exporting goods to them and them buying those goods and also importing goods, economically speaking, we will be impacted even though we might have done a good job of containing it here. The other countries that are maybe not doing such a good job, or the outbreak has just been worse in those situations, in those areas.
That'll weigh on us.
That will weigh on us. So it's an interesting situation.
Yeah, no, I agree. It certainly does. The interesting thing I find about this article is that they use some pretty strong language, obviously not like rude language, but still, strong language. And these guys, the IMF, they're not in the business of generating clicks. Like they're not just trying to shovel as many people as possible to their website. This is quotes out of a report, many people as possible to the report that they released said it is very likely this year that the global economy will experience its worst recession since the Great Depression, surpassing that of the GFC. To me, that sounds like something that someone at CNBC would write to draw someone to click on it. But I mean, this is the flippant IMF that have published this report.
If that's the reality, what are the articles going to say?
Oh my God. Well, what was the
crisis in 10,000 years?
No, that's the one from before. Economists warn things will never be the same again.
Oh, yeah.
Oh, dear.
Oh, God.
But yeah, very interesting. I wanted to open this up kind of as a bit of a discussion as well about what you think about the situation that we're in right now, because there are a lot of people that argue that kind of the worst is yet to come. And what we've seen now in the markets is obviously we had that initial bang drop, 30% crash Since then, it's bounced by, I think, at 20% or something like that, 20 something percent. And a lot of people now are kind of just thinking, bugger, I kind of, that ship has sailed, the stock market crashed and now it's just climbing back up to where it was before. But I'm just interested to hear your thoughts as to whether you think that this will continue to impact us for a long while yet, and will that drag over onto the markets, or what are you thinking?
Yeah, I mean, broadly speaking, I have no idea, and I hate giving that answer, but it's the most accurate answer that I can give. I mean, on an individual business basis, each business is dealing with these problems in a different way. And while broadly most stuff has sort of been pulled down, maybe 20 or 30%, there's some businesses that have been targeted more in terms of their stock price being sold more because investors think that they're more exposed to these impacts. But businesses are doing all different kinds of things. Some businesses are still going to be doing okay during this period. They'll be able to move their business around, reduce some costs, and they'll be okay, and others won't be. So I like to look at the individual business level, and even though the stock market in general might have bounced back up 20% after it dropped 30%, there's certainly a lot of businesses that have not experienced that bounce back and have continued to fall. And some of those businesses deserved their stock price to fall because the uncertainty increased. But for other businesses, that's not the case. And that's kind of where I like to look. And I don't think that, because the stock market goes down 30 and then goes up 20, that you've missed the opportunity to invest over the long term. Certainly, I think that the stock market is going to go up substantially over the long term, broadly speaking. So, I think it's too short-term minded to think, I should have invested last week and I would have had an extra 10% or a 20% gain. You need to think bigger, I think. I mean, if you're investing over a 30-year period, then a 20% gain early on isn't going to have a dramatic impact on your overall return. It will if you're trying to trade in and out over the next year, maybe. But over the very long term, it's not going to have a huge impact. And if you're broadly investing, then just consistently come back. And if it goes down further, you buy more. And if it goes up, you buy more. And you get the average.
Yeah, I agree with everything basically you just said there. What's interesting, just touching back on the point that you made about, looking more at don't necessarily look so much at the market decline, market bounce. Don't look at it at that kind of level, but start looking at more of those, the individual businesses that are being impacted and what's happening with that. One interesting thing that I saw, it reminded me to look this up, is that, for instance, there are companies like the airlines, which they're planes are being grounded and they're losing a heap of money because air travel is being destroyed. But at the same time, like if you look at a company like Facebook, their stock price has also taken a hit with the coronavirus. But I saw a report the other day that I just looked up again now just to make sure I had my facts right. They were saying in a blog on late Tuesday, I think last week, the social networking giant said that total messaging across the platform's services last month has increased 50% in countries that are ravaged by the virus, with video messaging on Messenger and WhatsApp more than doubling. And in Italy, time spent on Facebook has soared 70% since it was hit hard by the crisis. So, yeah, I think you're right. I think it's less about looking, I feel like I've missed the boat because the market went down. Now it's bouncing back up. I think it's more about, just look at the individual company, and, some companies are really going to feel the impact and potentially, for the worst, like with what we're talking about, say with Virgin Australia. There's some companies that are going to be impacted, but maybe will find themselves coming out of it okay. Like, for instance, one of these companies might be Facebook. Just reading off of that blog. I was going to say something else, but then I forgot. I lost my train of thought. Damn.
Yeah. Well, I mean, I think you need to ask yourself, if you're investing today or in this year, in this environment, you need to ask yourself, are you willing to forego returns in the next couple of years for long-term returns? Can you accept being negative in your portfolio for the next 2 years or the next year, but knowing that if you hold for 10 years, you're likely going to be substantially higher. Can you do that? That's really the question you need to ask. If you can't do that, if you can't deal with being, if you couldn't see your portfolio be negative for the next 18 months, then that's your answer. Don't invest, because the next 18 months is so uncertain. Nobody knows what's going to happen, or when all of this is going to fix itself, or if it's going to be a quick fix and all the economy is just back on track and everyone's back to employment, or whether it's going to be a slow, painful decline and then a slow, painful recovery. Nobody knows what it's going to look like.
That reminds me of a Charlie Munger quote as well, where he says, if you're not prepared to see the value of your portfolio drop by 50% at least a couple of times in your lifetime, if you're not prepared to see that happen, then you're not fit to be a common stockholder.
Yeah, that sounds right.
I think that's fairly accurate.
It is. And I mean, another great investor, Peter Lynch, he has a great interview. I think it goes for about an hour or something, but there's a 10-minute clip in there when he's talking about an investment in Taco Bell that he made. And he said that the stock went from $14 per share to $7. And he started investing at $7. And then it went to $1 per share. But the restaurant had no debt and they didn't close a single restaurant.
Right.
So he kept buying on the way down, and then it was bought out for $50 a share. So
wow,
to have that takes some serious discipline, and you have to know the business is great in that situation, because a lot of businesses that go from 14 to 1, the market might be right in a lot of those cases.
Yeah.
I mean, in the Virgin Australia case, I mean, they're on the brink of bankruptcy. So the fact that it went from $2.50 a share, 97% down to 6 cents a share, that's not a great company who's just been pulled down with the market. But in that case, it was. But he had to see some of his investment go from $7 to $1 before making 10, 15 times return on that investment. So
that's like making an investment in, what's Apple at right now? Apple stock.
250, 230.
Yeah, 280. So what's that? It's like, 280. It's like seeing Apple stock, making an investment at 280 and then it going down to like 20 or $30 a share.
Yeah, and buying more.
And buying more. Yeah, exactly. But yeah, pretty crazy. Just to finish off this topic as well, I remembered my train of thought from what we're talking about before. The other thing to consider is that even though we've seen markets going down and now back up, is that this is an economic situation that's going to play out over months and months and months to come. So it's always worth remembering that we're about to see Q1 data, which some of Q1 was impacted by what's going on with the virus. But then in another 3 or 4 months' time, we're going to start getting Q2 results come out. And Q2, obviously we're in Q2 right now and the shutdown is still continuing. So we're going to see Q2 numbers affected as well. So I feel like even though we're seeing the market drop and now it's bouncing back up by 20-odd%, I feel like there's still going to be plenty of opportunities ahead, whether it, probably be just in individual businesses or the market as a whole, especially considering that we haven't seen Q1 data yet and we're a long way away from seeing Q2 data. So.
Yeah, definitely. And I mean, I guess just to give people an update about earnings season and what we're probably going to be doing in regards to sharing that news. So earnings season started, I think it was last week or maybe it even started the week before, but usually at the very start, there's nothing too exciting. So I think I had a quick look over the last week. Johnson & Johnson reported their earnings, and their earnings were, their revenues, I should say, were flat and their earnings were down modestly. But despite that, they increased their dividend. Jeez. I couldn't get. I mean, they have a huge track record of paying that dividend. So
do they? I wonder if they have a long track record of consistently increasing the dividend.
I think they do.
Right. Yeah. So they probably just want to keep investors happy, because I was like, the way I would see a dividend payment right now in this climate would be like, why would you, it's okay if you pay it, if you're always known for paying a dividend, but why would you take it upon yourself to increase your dividend? It's like, I think that if anything, if I was known as being that big dividend payer that's always super consistent, I would just be like, yeah, we're paying the dividend, but we're not increasing it. I feel like if there's no pressure on you to increase your dividend, don't increase it right now.
Yeah, that's an interesting point because no one's looking for a dividend increase. People are just hoping that their companies don't cut their dividend in a lot of circumstances. So, I mean, I guess it's just to put some confidence back into investors to say, hey, our financial situation is so good that we're not cutting. It's not even staying the same. We're actually going to boost your dividend to offset some of the losses that you might have in other investments. So
I hate that actually works too. I hate it when companies just increase their dividend regardless. And basically they do that as a way to say to shareholders, look, we're doing really well. You should stick with us because we just increased our dividend. How good are we? When behind the curtain, they might not be doing well at all. They could be, I don't know, taking on debt just to pay a dividend.
Yeah, happens all the time.
Yeah, but I just hate it that there are so many investors out there that as long as they keep getting their dividends, and if that's the only thing they ever heard out of their company, that the dividend increased, then they would be happy.
Yeah. Something that just reminded me of is Starbucks. So since about 2018, when they had a new CEO come in, his role was basically, I'm going to take on a ton of debt and buy back stock.
Wow.
He pushed the stock price from about $50 up to about $100 per share in the space of about a year, and now it's back at 50. So you now have a company.
Clap.
Yeah. So now, great job. You now have a company with a ton of debt and nothing to show for it on the stock price. So thought I'd just
it'd be
up.
funny if they come out and they raise capital.
At 50.
Yeah, at 50. They're like, guys, we're really sorry, but we're going to have to sell some new stock.
Yeah, you know all those shares we bought back? We actually kept them and we're going to throw them back in the market.
Now we're going to sell them. No, we got rid of those ones and now we're selling these shiny new ones.
Yeah,
like these ones?
Yeah,
they're new. Oh gosh.
No, it's funny. No, but so a couple of banks also reported, but I can't get too excited about banks.
No, they're boring.
So banks, the headline really was that there was big declines in profits. JP Morgan was one I looked at specifically that had a 70% decline in profits. So year over year, that is. So that's, I mean,
still a big drop.
It's a big drop, and I think we're going to see that from a lot of companies going forward. But more importantly, I guess next week, which will be, so I guess over the next couple of weeks, we'll probably dedicate a decent chunk of the podcast episodes to talking about earnings, because I think it's I think a lot of people find that interesting, and we certainly find it interesting to talk about as well.
We'll make it interesting though. We won't just talk straight up. Here are the numbers. Here are the numbers. Here are the numbers. We'll make it interesting.
Yeah, we'll make it fun.
Yeah,
I promise. No, but we never trust someone who promises that something's going to be fun. By the way. Yeah,
this is going to be great. I promise. Trust me.
I promise. Trust me, guys. It'll be fun.
I'm going to stay home. Thanks.
You're going to have fun.
Yeah, it's going to be great. It's going to be the best thing you ever did. All right. No, thank you.
Anyway,
did I make you still got your train of thought?
Yes, I've still got it. Yeah, so we've got a few companies that we'll be able to talk about next week that are slightly interesting, or a little bit more interesting than the other ones. Or at least I'm very interested about these. So we have Chipotle, which is a restaurant company.
Chipotle update.
Yeah, Chipotle update. How many Chipotlanes have they disabled or put in?
Or put in? Jeez.
I mean, I presume they've put in more, right?
Because taking bets. Put your bets in the comments, guys.
How many Chipotlanes?
How many
20%
Chipotlanes?
Increase in Chipotlanes? 10% increase in Chipotlanes?
We will have to wait and see.
Yep. And we've got Netflix, which we'll be reporting. That might be an interesting one because of how much debt that they have, and see if they've taken on more debt. Have they cut? Are they going to slow down on spending on content to try and make sure they can pay off their debts? That'll be interesting. We have Delta.
I think
go on.
I was going to say, I think that'll be really interesting because you've got two things. Well, there's going to be two things I'll be looking at out of Netflix. I'll be looking at subscriptions to their service over Q1, and I'll be comparing that to Disney Plus, because remember, that battle is still raging. We've kind of forgotten about this battle because it's just been coronavirus. But I'll also be interested to see if maybe they saw a spike in their subscriptions now that everyone's staying home much more. That'll be interesting to see, because Netflix is one of those businesses that may benefit from everyone being at home at the moment. So you might see people canceling to maybe save money if maybe they've been stood down from their jobs. You might see the flip side where they're buying, they're paying, more people are paying for subscriptions because they want to consume content to pass the time while they're at home.
Yeah, definitely could see something like that. I mean, Disney Plus is already at 50 million subscribers, I think. I think that was their most recent announcement.
Wow.
Which is impressive. Insane.
That's impressive.
So where did that come from? Did that come from people just adding a Disney Plus subscription? Did it come from people canceling a Netflix? Did it come from people canceling a cable, which would just impact another part of Disney's business? But that'll be a very interesting thing to look out for. In terms of other companies, we have Delta Airlines reporting. So that'll be interesting to see how they're
taken the news, hasn't it?
Yeah, they're $60 million they're burning a day or whatever it was. $1 billion a year loss.
Yeah.
So we'll kind of see how that's playing out. CocaCola and Amazon report later in the week. So depending if they report, we may not be able to talk about those. We might have to save those for the week after, depending on when we do this podcast. But Coca-Cola, Amazon, of course, big companies that a lot of people are invested in and following at least. So there'll be some interesting ones. And then the weeks after that, there's lots of exciting companies for us to talk about.
I'm not sure if Coca-Cola will be a particularly interesting one. I'm just trying to see think out if they've been affected by the virus too much, but I probably don't think so. They'd probably just see a decline, maybe if they had to shut manufacturing facilities or something. But Amazon, I think, will see a spike. I would imagine that people have been buying more on Amazon, but then again, the shutdown, how many deliveries would they realistically been able to make? I don't know.
Yeah, I could imagine Amazon's revenues going up during this.
Yeah.
I could definitely imagine that with the amount of people
that there's so many parts to Amazon as well.
That's true. It's not just I guess, so their revenue for the most part is driven by their online store, but their profits is not necessarily driven by that, because I remember looking last time that their e-commerce platform, that Amazon.com, was almost not profitable. It's actually that it kind of just allows them to generate a huge amount of revenue, and then they have their other areas of business such as web services and Prime that generate most of their profit, their cash flow. So we'll see what happens with that one as well.
Yeah.
All right. Should we get into some Q&A? We had a couple of Q&A questions.
We do actually, yeah.
From last week. So I'll pose the first one to you.
Sure.
Going into earnings season, what would your advice be in terms of investing in US companies? Is it better to wait to see what their earnings are or invest now?
Oh, this is a good one. I think, this is tricky. I mean, you could very well make the case that you want to, if you're following Warren Buffett's rule one of investing, don't lose money. If you are thinking about making an investment in a company, but you know that, there's some uncertainty in what's going to happen to them, then maybe you do just want to wait on the sidelines and see. I mean, you're not going to lose money by not investing. If you just want to see what this company is, what's going to happen with their, say, Q1 numbers or something. But I think that for me, I tend not to wait for earnings. I guess the companies that I look into, I'm pretty confident that in the long term, they'll be okay. And that's what we're always saying. I'm always thinking about investing for the long term. So, if I might try and model out what could happen in Q1 or Q2. But overall, doesn't really faze me too much. I mean, as long as I've checked the other big things like the debts and all that to make sure they're going to, get through okay, then I'm not super concerned about what their earnings might be in, say, the next quarter or 2 quarters, if I'm buying a great business and I want to own it for 10 to 20 years kind of thing. Does that kind of align with your thinking, or do you have a different perspective? Or?
Yeah, no, I agree. I think that if this earnings report will give you some more clarity in terms of whether the company meets all of the major requirements. So whether it has competitive advantage, good management team, low debt, that kind of thing. If seeing the earnings report is important for you to solidify in your analysis that it does meet those requirements, then I would wait. So let me give you an example, because that might be a little bit confusing. If there's a company that's struggling particularly at the moment, and we know that they've taken on more debt, maybe you would like to see their official financial statements to make sure that the debt is low enough for you to feel that the company won't go out of business. So that might be an example of where you want to see the financial statements before you invest. But for most businesses that follow the Warren Buffett principles of investing, which is what I'm looking at, the company should be in a position already that it has low levels of debt, it has a sustainable competitive advantage, it has a good management team, to the point where this quarter's earnings shouldn't really matter too much. And yeah, I mean, I think it would matter more looking at quarterly earnings if the company is really struggling with lots of debt, and they're struggling to stay afloat, which is kind of the investments that I would avoid in the first place. But yeah, I mean, in terms of trading on earnings, I don't trade on earnings at all. I don't wait to see, or I don't try and buy before. Yeah, I mean, anything could happen. You have... It's not about whether the earnings are good or bad. It's about how they compare to expectations. And expectations is an unknown. It's an unknowable thing. You can't know the expectations of the market going into earnings. You just can't know what people are expecting.
Exactly right. It's just whether or not it hits the earnings hit what the analysts think they're going to hit, and if they exceed that, then the stock price generally goes up, and if they don't hit what the analysts are expecting, then the stock price usually takes a little dip.
Yeah, but there's even situations where that doesn't play out at all as well. There's situations where they beat analyst expectations and it still goes down.
Yeah, there's something that they come out with that sends it down. Yeah.
Yeah, because it's impossible to know what the broader expectations of investors are. So
yeah,
don't trade it.
Don't trade earnings. Just think about the long term with good companies. All right, next question. Here we go. This is quite a long question, so I'll read this one out.
Yeah.
Hey guys, I have a question regarding capital raising. AIA, I believe. I'm not sure what stock that is. Do you know what AIA is?
No, I have no idea what that is.
Anyway, this company has announced that they are going to conduct capital raising from the 7th to the 24th of April, as I remember, and it will be updated onto the ASX on the 30th of April. I was wondering when the stock price would feel the impact of capital raising. Will it be during the 7th to the 24th when it was announced and conducted, or will it be after the 30th of April when it was updated onto the ASX? Thanks again.
Yeah. In terms of that company specifically, I can't comment on it. I don't know what that company is, but generally speaking, the markets work on expectation. So as soon as it's known publicly that is something that's going to happen, the market will move based on that. But it also depends on the certainty of the capital raise as well, because there'll be some situations where a company is raising capital and it's a certainty that there will be enough demand for them to raise the entire amount. So the effects of the capital raise are almost entirely certain. In those circumstances, you would expect the stock price, as soon as it's announced, to move almost immediately to where the impact of that capital raise would be. Yeah, but there's other situations where, especially now, where there's not so much clarity or certainty around whether a capital raise will be successful or not, because of if a company's stock has fallen 70% or 80%, kind of like Kathmandu we spoke about last week, their stock price fell 70%, then they had to raise capital, and they were able to raise 150 million, but they wanted 200 million. So in that circumstance, when it was announced, everyone thought, okay, they're going to try raise 200 million, but there wasn't entire certainty about how much they would end up raising, and then therefore how much it would affect the stock price. So then in that circumstance, it would have moved on the announcement, and then it would have moved again after it had been confirmed that they didn't raise the full amount. So I mean, that explanation is a roundabout way of me saying you can't really know what's going to happen, and it's not a good idea to trade on that kind of information. I just think generally that's not a good thing to be doing, to be trying to trade on an announcement or anything like that, because ultimately you don't know how the market's going to react.
But generally speaking, I would say that the market moves pretty much instantly after the announcement's been made. Basically, I'd say that in most cases, if the market if there's any announcement of news, then as soon as the market hears about that announcement, whether it's good or bad, whether it's a capital raise, whether it's any sort of announcement, it's pretty much as soon as the market hears about it, then it will move straight away.
Yeah, definitely. Yeah.
Yeah. But yeah, exactly right. It's like whether or not the capital raise actually goes through, and all that stuff can then impact the share price further down the process, I suppose.
Yeah, I mean, it's kind of like this. If a company announces that they had an offer from another company to buy them at a specific stock price, then there's at that point, and let's say that the offer is going to go through. Let's say the CEO says this is a done deal. This is an offer, but it's a done deal. The stock price will move immediately to the exact point at where it should be.
Yes. Because
the certainty of that outcome on the announcement, it's certain, right?
Yeah.
Or it's highly certain.
It's highly likely.
Whereas if you have an Apple, for example, announcing they have a new phone that's radically different from their other phones in the past, the market's going to move, but there's no set point at which the market knows where to move. It would just depend on what people think that will have an impact in the future. So it depends on, there will be a move on the announcement, I think, in most cases, but where it will move depends on the certainty of the event that's happening.
Yeah. Yeah. I think that's a good answer to that question. We actually ended up speaking about that one for quite a while. All right. Should we do maybe one more? One or two more?
Yeah, let's do one more. I'll read one to you.
Okay.
Which one have we got? All right, let's read this first one here. So what is your opinion on research platforms like Morningstar and Credit Suisse?
Suisse or something, yeah.
Suisse?
I don't know how to pronounce it. I don't use them personally.
Yeah. Me neither.
Yeah, I think that those ones are great. They give you some good data for free, but typically their model is that then you pay a subscription fee to see research reports or analyst recommendations and that sort of stuff. For research reports, maybe I might consider it, but certainly not for recommendations. I wouldn't subscribe to a service that gives me stock recommendations ever. That's just totally not the way I go about it. But typically I've found that for my investing, I can do everything that I need to do without paying for a subscription. I mean, the data, it gets released by the company. Like all the data you could ever need is given out in those quarterly reports, the annual reports. So that's really where I get the vast majority of my information, but obviously you don't have to sift through annual reports just to get, 10 years of data. But there are plenty of free websites out there, even just like a Yahoo Finance, which tabulates all of those financial numbers, so that you can look over, 4 or 5 years. So for me personally, I've never needed to buy a subscription to like Morningstar or Credit Suisse or anything like that.
Yeah, I mean,
what about you?
Yeah, I don't have any paid subscriptions at the moment. There's a website called QuickFS that gives you 10 years of financial data. So I just go there and then I have my spreadsheet that's available for free if anyone wants to download it. But it basically does a couple of graphs and tables and growth calculations for you. That is similar to what a lot of these sites would offer, although there's a lot more flexibility on a site like Morningstar where you can put together some nice graphs. But it's really, do you value the money more or the time? And if you're investing a small amount of money, then you should probably value your money more because it's going to compound to a lot. The opportunity cost, I guess, of paying for this service versus investing that money is a lot higher than if you're investing, $500,000 or $1 million and you're paying a couple $100 a year for this service. The opportunity cost isn't as much. But
yeah, that's a good point.
I personally like to do it all myself. I like to dive into the numbers and make my own graphs. And usually the graphs that I want to look at are not available on these sites anyway. Like I might want to look at same store sales for a restaurant company and graph that out compared to the traffic. And then stuff like that is not as easy to find, even on these paid websites. So I do it all myself.
Yeah. It also, if you do it yourself, it gives you a much better understanding.
That's true. Yeah.
So that I've always just forced myself to do it myself kind of thing. Because, even if I see a chart of return on invested capital over the past 5 years for some company, that's great. But I still like, I don't know, there's just something about it. I still like having gone through the process to calculate those numbers myself. I don't know, it just makes me feel much more sure of the numbers or the graph that I'm looking at, kind of thing. And it gives me a better understanding of all those numbers as well. So
no, that's a really good point, actually, because if you just pull up a chart from some website that gives you the return on invested capital, yes, you would now know what the return on invested capital is maybe over multiple years. But if you do it yourself, then you're having to look at, okay, well, how much debt is contributing to this formula, and how has this debt changed over time, and how much equity has changed over time, and how much cash flow has changed. Because if the return on invested capital, just to continue with that example, if that drops, it could be because cash flows dropped, or it could be because cash flows were flat and the capital invested was higher, or it could be because debt was higher. There's so many different, there's a few different components that go into that. So yeah, doing it yourself and going through the motions and thinking about it critically, I think really helps you develop a more full picture of a company. Yeah.
All right, cool.
Should we wrap it up there?
Yeah, I think that's a good place to wrap it up.
Yeah, thanks everyone for listening in, tuning in on this Saturday morning, and thanks Brandon for joining me as always.
That's all right. No worries, mate.
We should also say thanks to our sponsor. So thanks ShareSite. Again, if you want to get 2 months free when you sign up to a yearly subscription, or you just want to try it out for free, then you can do either of those things by heading over to sharesite.com/young investors. But yeah, we'll be back next week with some earnings season news, which will be exciting. We can get into the first week of a few weeks where we'll be discussing quite a bit of earnings season, and of course we'll bring you all of the other important information that's been happening throughout the week. But other than that, thanks everyone, and we'll see you guys next week.
See ya.